We got a hot stock that's in play, and now it's a battle of the billionaires. Which stock is going to go higher? So that hot stock today, we have a hot opportunity with some hot options and a great option trade to fade this new 52-week high. So my name is Joshua Belanger. This is another episode of Follow the Money, and let's take a look at Tesla. Tesla shares here, a new 52-week high. It's all-time high, actually. Not even 52. It's 52 and all-time high and just craziness high, if you want to sum it up that way. Anyways, a lot of euphoria in the marketplace, a lot of day trading, and right now it's sitting at 816.99. That's where it closed. Now, a lot of people would look at this and say, well, Josh, it's overextended. Can we get short here? You know, a lot of people have been trying to get short Tesla for years, and it's been a painful trade. A lot of people have gone under, have blown out trying to short Tesla. And right now with the Biden administration taking over, money's going green, and there's just a lot of euphoria and a lot of day trading in the marketplace. But that's not going to stop us. If you came to me and asked, hey, Josh, what is the best way to trade this? Should I go long calls? Should I fade it? Or should I do a neutral strategy? Being that if it's given, we're talking about options here. Now, I'm going to show you how to fade it here, but one thing I want to show you is why it's important to follow the money. Yesterday in the option market was very hot. So again, it's always a precursor. You see the options and then you see the stock move. If we take a look here at the Analyze tab, and this is yesterday's action at 1/6/2021. Now, why simulated trading account? This is educational. That's why. So educational being that this is not a recommendation. Yesterday, a lot of hot option activity in the January 8 that expires in 2 days at that time, so it expires this Friday. At the 800 strike there, 81,000 contracts traded. Now, the open interest on that was 20,000, so these added more, and they were buying them anywhere from $1.50 all the way up to, I think, about $3 yesterday. So this open interest stuck today if we fast forward. And you could see now they traded and closed at $21. So a lot of, so the open interest is not showing on this one, but you can see there was a lot of action and a lot of interest in those calls yesterday and even today. So those fast trades, again, the option activity, the options gave a precursor of what's going on here. Now, granted, I didn't take advantage of this. This is something I did see. $2 for a trade that expires in 2 days. There's different ways to structure it. I mean, that's a little gambling to me. So it's always good to know what's going on. And sometimes you see it and it goes by and it's just like that. So that's the reason why I follow the money. But now, what's the trade right now? We got shares all the way. You know, Joshua missed that. I missed it as well. What the hell do we do? Well, right now, what do I look to do? I would say the euphoria, there's a lot of interest. When we see this euphoria in the marketplace, you start to see the interest, you start to see out of the money calls getting bid up, meaning that there's more fear, prices going higher than the opposite, which is natural for stock options to see puts have a higher premium than on the call side. Not saying that's on Tesla right now, but one way to fade this, it's a unique way. It's something I haven't talked about a lot. It's a very structured trade, but it's known as a broken wing. Well, it's not broken. This is not a broken wing. It's going to be an unbalanced butterfly here. So what we're going to look here is that we have an expiration of 8 days. And my thinking on this is we're going to fade this, but we're going to fade it in a structured way where we're going to have an opportunity to make money if it does go into our range and exceeds the priced-in range, and or if prices do go lower. I refer to sometimes these as jackpot trades. So if we take a look here, the way that I would be looking at this is, right now, we talked about in a previous video, expected ranges. Right now, the expected range is $70. So 70 plus 816 puts us right around the 890 mark. So that's a one standard deviation right now. That's a pretty big range. So if we look at that level here, and that's going to be right there. One of the things we want to look at is, well, if something exceeds one standard deviation, it typically is going to push to 2 standard deviations. So that's where I usually structure this. That's an insider tip there. So what I would do here is I would look to, this is how it would look. This is unbalanced butterfly. I'm not going to go too much in depth. You're going to see right here. So what this does is create a 43-cent debit, or 43-cent credit. So you're actually taking money, you're getting paid to trade this. Now the max profit on this, I'm not going to go through the whole risk profile. The risk starts to come after 940. So if prices start to exceed 940 plus the 43 cents you take in, that's where the risk starts to come in, and that's where you start to see the negative. So prices in the next 8 days have to go to 940 or higher. Now, the probability on that is a 10% probability that doesn't happen. And also, if it expires at 940, which typically you're not going to want to hold this into that expiration, you would be looking to get a max profit if prices expired exactly at 940. So this is a very structured trade. I have 10 by 30 by 20 here. So you're buying the 920s, you're selling 3 times, or well, how this is structured in one click, it would be is you're buying the calls, selling 3 times that, so 1 by 3 by 2. So you're using the out of the money call to just hedge to offset that. So it's an embedded call spread, debit spread, or call spread, credit spread built into it. So that's why you create this unbalance. And you're selling one more to collect a little bit of extra premium on this one. So this is the way that I would fade it. It's structured. It's the great thing about options. You don't have to play them just a single leg. Now, Robinhood traders, yeah, you're going to play them directly like that. But when you start to have more money and you're looking to manage risk more sophisticated, you can do and put on positions like this and have different strategies, which is a way to reduce risk and also diversify. So that's what I have on Tesla. That's the way I would play right now. I mean, it's an $816 stock. Options are going to be pretty expensive playing single leg. You have to go way out of the money, so you have to play spreads, or you have to be a little bit more strategic when a smaller account. So this is the ways that you would do that. So that is what I have on Tesla. Let's see how this works out. And I will see you in the next Follow the Money. Until then, good trading. Take care.